Cash management services market leader CMS Infosystems continued the growth and margin expansion in Q1 FY23. Sequentially, revenue growth of 2.1% and a 122 bps reduction in operating costs aided the EBITDA margin expansion to reach 27.3% in a seasonally weak quarter, which is also its highest ever EBITDA margin. Cash management segment revenue grew 4.8%, led by an increase in network points and a 3% rise in implied blended revenue per network point over Q4 FY22. Cash circulation has grown despite UPI's popularity. Beyond the large cities, cash remains a prominent mode of transaction as evident by cash in circulation or CIC growth post-demonetization at a CAGR of 19% from FY17 to 22 and 14.6% from FY18 to 22. CIC's sequential growth in Q1 FY23 stood at 2.5%. With such volume, cash velocity, which is ATM withdrawals or CIC, it's still catching up and would improve with rise in number of ATMs via withdrawals. ATM market in India is the third largest. However, the penetration in semi-urban and rural areas is still low. With Jan Dhan accounts driven banking access, banks now appear to be aiming to scale ATM networks and hence likely to provide growth impetus for companies like CMS. The managed services business is expected to be the growth engine and a key margin driver for the company. It currently has about 5,500 brown label ATMs or BLAs and has been selective to expand with the target of adding 1,000 ATMs per year. Now, year to date, CMS has executed 95% of its BLA order book. Furthermore, the remote monitoring business has been doing well with 15,000 sites already gone live out of the order book of 25,000, which is 60% of the execution. Additionally, the company also won 1,000 non-ATM site contracts this quarter. The cash management services market is a mature play and in consolidation, which means a large market share gain would be difficult for an existing player as the contracts are long-term and some may even come integrated with managed services as well. However, the opportunity to upsell to the existing customer would be easier for an established player. Now, strict regulations and large initial investment requirements to build the network and logistics makes the business less attractive for a new entrant. Now, such an industry structure typically favors the market leader, which is of course CMS in this case. CMS's revenue and PAT have grown at a 3-year CAGR of 11.5% and 32.5% respectively, and we expect it to grow at 19.4% and 27.6% over FY22 to 24, propelled by cash management or managed services segment with a growth of 15.4% and 27.9% respectively. At the current market price, the stock is trading at 11.3 times FY24 EPS, which we believe is cheap for a growing business that's delivering 20% plus ROE and trading at an FY24 PEG ratio of 0.4. CMS Infosystems has outperformed the Nifty50 and the Nifty Small Cap 250 indices on a year-to-date, 3 months and 1 month basis. During economic uncertainty, low beta stocks offer stability and relative protection. Now, CMS fits very well in that ambit and therefore makes for an attractive buy for medium to long-term investment horizon. Of course, like any other company, there will be some risks to keep on your radar as well. Very fast cash to digital transition and or a failure to meet RBI compliance in future will be some potential risks to watch out for.